Hello my fellow freedom builders and welcome back to the channel. In today's video we are gonna have a little battle between two tobacco companies. One is a very big, very large, well-known entity, and the other is a bit of an outlier that I must admit I didn't know all the details about before starting to do my research here. Now the two of them is, and we can see it here in mystockscanner.com, that is Altria Group with the ticker symbol MO. That is one of the really big ones you can see here with a revenue of $20+ billion. And the other is a smaller one, Vector Group, VGR in ticker symbol, with about, as you can see, $1.5 billion have been cut down somewhat. But it is a bit of a strange company because they have something else than tobacco, and we're going to have a look at that. However, I'm going to compare them side by side. And first of all, if we're looking at Altria Group, and just a quick note here, Altria Group, when you go into their website, of course, you can find the investor presentations and you can read all about their products there. They are focused very much from going from a tobacco smoke product company to a smoke-free tobacco company, and that shows in many of their presentations here that they are actually focusing, well, they have their Marlboro brand that I guess we all know, even though we're not smoking, but they're also looking a lot into vapor, they're into heated tobacco, and especially oral tobacco that, at least here in Denmark, is getting really crazy. Everyone seems to be using that instead of smoking. They have all the explanation of these products down here, and it's actually quite interesting to see how they are moving towards the non-smoke products, but you can read more about that. I'll put a link to that below. However, looking at the Altria Group here, you can see that at least they have been fairly steady in their revenue. It's not, they have an average CAGR in revenue since 2017 of only 1.1% per year. So what you're getting here is definitely not a high growth company. It is, many would say, fairly well priced with a PE ratio of 9.2. We don't have the PEG ratio, we are missing some growth estimates here. But the earnings per share growth is estimated to be 62%, coming from a low point. Coming from some negative numbers. So the quality of the company, return on capital 30%, return on equity because they had a deficit and they were moving around some numbers, but operating margins very high, almost 60% here. Petrosky score high, high Altman C score, and the analysts are fairly neutral on it. Compare that to VGR here. They have been cut down. I am pretty sure they sold off a division at some point here. And they have around $1.5 billion. If we are looking at them up here, PE ratio about the same at 10, PEG ratio at 0.6, meaning you're taking the price earning divided by the growth, and that is to see if you're paying too much for future growth. They have an earnings per share growth of 22%. And looking at that here is way more steady than the one in Altria. Also reasonable, return on capital and operating margins. They have significantly lower operating margins, but let me just address that for a second, because if we are looking at, let's just have a quick look, Vector Group here, it's actually not a pure tobacco company. They are basically two. It says we own and operate iconic brand names in discount tobacco called the Liggett Group, and real estate investments, the New Valley. So basically this company is kind of split in two, where we have the Liggett, and I must admit, since I'm not smoking and I'm not from United States, I don't really know these brands. Maybe they're sold outside United States as well. Eagles 20, Montego, Pyramids, Grand Prix, I don't know them, but they are selling that and have a 150 year anniversary in 2023. The other group is the New Valley. That is some iconic properties that they own, and that they are running. So that is a bit of a strange company, and I looked it up, and it is listed as, at least in my database, as a tobacco company. However, it is very split, and that means, is the comparison fair here? Maybe not. We can at least not compare them like apples to apples. It is a bit different here. So looking at, for instance, the operating margins with Altria Group, operating margins on tobacco is normally quite high. But of course, when we are looking at the Vector Group here, it is quite different. Now, looking over here in Seeking Alpha, I often use them just to see what are their different factor grades. Altria Group, well, they are putting it in an A- here on the valuation. The growth they're not impressed with, but you saw that especially on the revenue side with almost no profit or growth at all. They are quite profitable. Momentum is reasonable, and there are some upwards revisions. Now, the Altria Group, many of the investors here, at least many of the ones I have been talking to, are in it for the dividends. And you can see here, dividend safety, or maybe we should just start out with the yield. That is what interests many people. The dividend yield is up around 8%, which is quite impressive, and the sector median is around 2.5%. So that is quite a lot, and I know a lot of dividend investors that are simply buying it to get the dividends, and I see that. I see why they do that. However, another thing you should have a look at is the safety and the payout ratio. There are different numbers. This is a trailing 12 month, and there is a percentage of the payout ratio on GAAP and non-GAAP. But it is up in the 75 to 116%. That means that they are actually paying out more than they earned some years in dividends. That is not my favorite, to be honest. I would not buy this just for the dividends. The dividend is nice, but it is always a battle. Do I want to get the dividend paid out? I need to pay taxes on them. Or would I more like a company that keeps the money inside and actually uses these dividends internally in the company to grow the company? But there might be some cap on how much Altria can grow right now. They cannot grow with 10 or 20% per year, especially in an environment, business environment, where the smoking part is a kind of, I wouldn't say unethical, but it is. The tobacco companies sometimes get they get not picked by investors simply because of some ethical factors. If you're looking at the Vector Group, if we just go up here, you can see this was a reasonable factor grading here. The factor grading here at the Vector Group is actually, well, a bit better maybe. Valuation, profitability, momentum. If we look at the dividend grades down here, we can see that the yield is it's not the same. It's around 6.5%, so that is reasonable. If we take a look at the safety of it, we can see that they are also up in the 70 to 80% dividend payout. That is probably mainly because there is some cash flow coming out just selling tobacco. And then I haven't looked really deeply into their real estate portfolio, but we also see in many real estate for companies, REITs, that they can pay out quite a lot in dividends simply because of the way the company is structured. So both of them could be picked as dividend stocks. One of them smaller, the other one quite a lot larger. Let's just return to the My Stock Scanner here and have a quick look at the charts. Let's just compare them side by side here. Now, if you're looking at the basic earnings, then if you have seen my last video about stocks, stock analysis, you might know this chart. This is simply right now 10 years where they have taken the average price earning over these 10 years. That is around 9 for Altria Group. And then they have used the prices all through these 10 years. And then they're saying, how is the price related to the average price earning? And if investors are willing to keep paying the average price earning over the last 10 years here, a price earning of 9, and if their estimates for the future is holding up, then this should be in the area where it is priced. So there's not too much room to the upside here. You could also choose to look at the free cash flow, and here you can see that there is over the last 10 years an average price to free cash flow of 18, meaning that if investors will be willing to pay that in the future, I don't have the estimates for the free cash flow, I should say, but then there is definitely some room upwards here. We can also have a look at if the price earning is getting better or worse, and you can see moving in here that definitely is some changes on Altria where the investors are not willing to pay quite as a lot in price earning. Now this is average price earning, so of course when they've had a very negative year, that will skew the average a bit. Going over here, we can see again on 10 years basic earnings, we can see that the Vector Group has had an average price earning on 22.6, which is a lot higher, but it seems like investors, or it is hovering around this average. And right now, if investors should be willing to keep paying 22.6, there's definitely some upside room here. Right now, it is traded around the 12-13 mark, and it could, if people are willing to go up here, get doubled over a couple of years. We can see if this is getting better. It is actually not the price earning. Seems like investors are not willing to pay quite as much. But even here, we can see whether we can move from a 12-13 mark here and up towards 18 or 19 within a couple of years. Looking at the free cash flow, there's also definitely some room to move here, at least on the 10-year time span here. They have an average price to free cash flow over the last 5 years of 8.4, which is actually reasonable, I think. All right, let's just have a quick look in here before we look at the charts to see if there's anything on the technical analysis part. Now, in the Guru Focus here, they have the discounted cash flow calculator. I know that is coming to my stock scanner as well. But in here, you might know it already, but the discounted cash flow is basically where you're looking at, for instance, the earnings per share. You're saying how much you are aiming to get per year. You have a discount rate of 10%. And if you're looking 10 years out in the future and they have a growth rate of 5% in earnings per share, then what would a fair price be if you're calculating 10 years out and then discounting it back to a fair price now? It sounds a bit complicated. I'll make a video about it soon. We'll also come with other valuation methods, but this is mostly, even though I'm normally mostly a technical analyst, I like to see where the fundamental analysts, where they are thinking a target should be. I like to see if they are seeing the stock as completely overvalued. If I can find an alternative that is undervalued and still are giving me the same good technical buy signals, I might go for the undervalued part simply to have a larger margin of safety also compared to the fundamental analysts. So right now, if we're looking over the next 10 years, we are aiming for a discount rate of 10% and we have a growth rate of 5% in the company. Right now, it shows that there is a negative margin of safety, meaning that the Altria is priced up around 47 and a fair value should be in the area of the 39. Now, we can try and see what growth rate should be before we hit some reasonable fairly valued number here, and that is around, and also up here, 7.4%. And looking at the earnings per share without non-recurring items here, I would say that 8% per year is on the high end. That is definitely not something I think would be realistic. What about if we're looking at the free cash flow here? We can see that over the last 10 years that has grown with 10.4%. And if it can keep doing that, it is actually measured on a free cash flow, quite fairly priced, and could even get somewhat lower down, actually down to 3% here. But it is a very volatile stock on the earnings. You can see the EBITDA here, the earnings per share without NRI. So it's not a very predictable company. Guru Focus also says that by only giving it 1 star here on the predictability. If we're looking at the summary here, we can also see that here are some of the different valuation charts here. There's a Guru Focus value. There are some different valuation methods, but some of them are saying it is okay valued, but at least if we're looking at the discounted cash flow, which is a purely mathematical model, of course, then it is overvalued looking at the earnings per share, and it is undervalued looking at the free cash flow. Looking at the Vector Group here is a bit of the same picture actually, but looking at the discounted cash flow is, if we're just choosing that, we can see that it is actually quite undervalued just looking at the free cash flow. And I should say it is not basically my favorite model, but this is a very good visual representation here. And we can see that it could, so this was the free cash flow. We also can look at the earnings per share here. And no matter if you're looking at earnings per share or free cash flow, you can see that we are actually getting some undervalued statement. That means that if people are still interested in 10% per year, and we are calculating 10 years out in the future, then it will grow by 15% per year. Then we are getting some very good upside potential. Now, the growth rate could drop quite dramatically, and we would still be in an undervalued area. Again, I'm not 100% a value or fundamental investor, not at all, but I do like to look at these numbers to see, okay, all the many millions fundamental investors, what are they looking at? And they would definitely look at Vector Group as better valuated than the MO, the Altria. Again, we should remember that even though I'm saying this is a tobacco battle, the tobacco part is only a part of the Vector Group, so it is a bit of an unfair comparison. I will give you that. All right, last but not least, we'll have a look at the charts here. And on the looking at the Altria Group on a weekly time frame here, we can see, and that is a nice thing, but while zooming a bit out, we can see that the Altria Group has been in a big downtrend, and people saying that this is just coincident, that we can try and pull on a regression channel here, and we can see that it fits quite perfectly. And this is not a coincidence. This is the big players in the market having an idea of where the target should be, and every time it gets overbought over this regression channel where they think it should go, they are simply selling more out. That is at least what this looks like. Now, it started at an uptick here, definitely, and then since last summer, spring, summer, it took a big downturn here. There was some news here, and then it's slowly building up. Over the looking at it in a long-term perspective, this is actually a reasonable upwards trend. And if we took this away, and this was some extraordinary news here, and we imagine moving this one up to this point, we would actually be in a very good uptrend. So technically on a weekly time frame, this is actually not a bad look, not at all. Looking at the VGR, the Vector Group here, we can see that it is a bit more messy. And it was in a good trend here, and definitely when it moves, it really moves. It went from down here in the just below 2, and then it went up 6x, 7x up here, went down again. And right now, well, you could draw some lines here, and that is of course a danger doing technical analysis, that you can sometimes get to draw some lines that really aren't there, or that you're drawing because you wish it is the right place to draw them. But there are definitely a line here that have been tested a number of times, and right now this is, if you're looking for the longer term time frame, this could look okay actually. We could also draw some resistance area here, and if I had my long term goggles on here, I think I would wait, if I'm just finding my drawing tool here, for a bit of an uptick here, and then a retracement down to this line, and then a movement up again. But again, that is different from investor to investor, and if you are more of a value type of investor, you would be trying to catch it down here somewhere. Now, why should we choose either of these? If you are looking for a pure tobacco company with some reasonable dividends and a good solid, the fundamentals are good and solid, then definitely Altria Group is good. It is a very large company. It has some very well-established brands, and that is definitely something that you could go for, especially if we are going into a recessionary economic territory. Then tobacco normally is not the worst place to be, because it is something people still tend to spend their money on, and it is what is called an affordable luxury. Some would say it's not a luxury because people can get addicted to it, but that is how to interpret it. Now, the Vector Group is a bit more of a strange play, you could say. It's not paying, it's not paying as much dividend. Maybe the dividend security is a bit better, but it is this strange hybrid between a tobacco company and a real estate. And I have no idea. I haven't looked into their history. I have no idea how they ended up being part tobacco, part real estate. But I thought I would mention it to you because it popped on my list of peers, and I looked a bit into it, and it was just a funny construction. The numbers are actually reasonable. It looks as it could be somewhat more undervalued than the Altria, but I know many dividend investors that are looking to place their money in some really good long-term investments that can go on for years and years and years. Then that should probably be Altria that you should pick. Also because long-term dividend investors are not quite as much focused on value as they are on some solid dividends. And a dividend of 8%, even though they pay out basically all they earn, that is some very solid dividend, definitely. All right, that's it for now. Let me know in the comment section below if you have some thoughts on the two companies. This is definitely not a completely 100% in-depth, thorough analysis. This is just to make you aware of the two companies, and as always, you need to make your own investment decisions. That's all for now. Take care of yourself and your money out there, and I'll talk to you again shortly. Bye.